Global Weekly Overview, August 4th to 8th, 2025. Amid a burst of geopolitical and economic news, Wall Street accelerated again toward the end of the week. The Nasdaq ran to a new high, and the S&P 500 closed near its record. The question wasn't whether news arrived, but what the market filtered out of it. The rhythm of the week was set by a new wave of the U.S. tariff package. By Thursday, the reciprocal increases took effect against several dozen partners. According to analyses, the average effective consumer tariff burden has jumped close to a modern-era peak. In the short term, this distorts import prices and supply chains, and in the medium term, it poses an inflation risk that complicates the Fed path. Meanwhile, real economy signals were mixed. The ISM Services PMI slowed to 50.1 for July, the boundary between growth and contraction, and the employment component remained deep in contraction. This supports the slowing but not collapsing growth narrative and explains why markets are still pricing the chance of a September rate cut. There was a sharp divergence in commodities. Gold raced close to a record, partly because of tariff headlines, including a high tariff on Swiss cast gold bars and safe haven demand. In parallel, long yields rose, with the 10-year climbing toward approximately 4.28%. Oil, by contrast, slipped near an 8-week low during the week, fueled by trade tensions and uncertainty around sanctions on Russia. Together, the two paint a typical risk mix: inflation risk plus growth drag. The geopolitical backdrop wasn't quiet either. European statements about a freezing situation on the Ukraine front and speculation around U.S.-Russia channels both shaped the risk premium. The message to equity markets: politics is moving both cyclicals and defensives, so investors reacted with quick rotations to the headlines. And then the market. On the week, the S&P 500 plus 2.4%, the Nasdaq plus 3.9%, the Dow plus 1.3%. On Friday, the Nasdaq set another record, and the S&P missed its high by a hair. The move was led by megatechs and earnings winners. The AI narrative and tariff-sensitive stories moved sentiment in tandem. The U.S. takeaway in brief: when tariffs and the data mix simultaneously push inflation risk up and growth down, the market looks for the gap. Those segments and companies that can pass through costs, or can be shielded by political promises and investment plans. Gold's rise and oil's weakness traced exactly this duality during the week. Now come the quarterly earnings reported this week, and how they rewrote the story. In technology, two extremes collided this week. The trade desk signaled a 30 to 40% plunge, indicating that advertiser budgets are already being yanked around by the tariff shock, and competition from Amazon and CTV isn't letting up. By contrast, Palantir delivered a historic quarter. It crossed $1 billion in quarterly revenue for the first time, with growth driven by the U.S. government and even more, the domestic commercial business. AI project pipelines are thickening, and management pulled the full-year outlook higher. This kind of high gross margin software model proved more recession resilient this week. In semiconductors, AMD's numbers were strong in themselves, revenue plus 32% year-over-year, yet the market reaction was cooled by communication around export restrictions and uncertainty in the inventory and AI chain. The sector instead priced the more policy-sensitive Apple story this week. The company's U.S. investment promise and hopes of tariff relief brought a spectacular share price rally, which pulled the broader megatech cohort as well. In consumer, the split was textbook. Expedia beat expectations across the board: revenue, EPS, bookings, and even raised guidance. That signals that non-discretionary, less price-sensitive travel layers are still withstanding tariff and price pressures. At Under Armour, however, tariff cost impacts and weaker demand bit at the same time. Management materially cut its outlook, and the share price fell accordingly. On the beverages and defensive side, Monster Beverage showed broad-based growth, double-digit revenue expansion, improving gross margin, stable demand in zero-sugar products. In healthcare, Gilead proved that pipeline plus portfolio mix can pull together. Revenue and profit came in above expectations. The HIV leg is strong, and the newly approved twice-yearly PrEP injection gives a meaningful new story for the next years. The market rewarded it with a jump of over 8%. In media, Disney delivered a solid but not overwhelming report. Beat on EPS, slight miss on revenue. The focus now is on the ESPN strategy and the monetization of streaming. The reaction was measured, but beyond their own execution, the tariff environment is also shaping the narrative. Bottom line for the week: in the tariff stress test, Those did well who have strong pricing power or a political and investment promise that protects their cost chain. Those dependent on advertising or low-cost apparel demand got a reality check. The weekly moves were driven by two forces: megatech optimism, the Apple effect, and earnings selection. From this came the Nasdaq leading at plus 3.9%, S&P second at plus 2.4%, and the Dow lagging with its industrial character at plus 1.3%. Despite rising yields, 10-year approximately 4.28%, growth stocks outperformed, which shows how narrative-driven the market is right now. What do you see as stronger right now? Persistent margin pressure due to the tariff shock, retail, advertising, or the escape route via U.S. investments and pricing power, megatech, pharma, premium consumption? Write in the comments which earnings report surprised you the most and why. My strategy has not changed. NVIDIA's earnings report is due in about 3 weeks. In the stock market, that's a long time, and a lot can happen and has happened in the meantime. Sentiment can flip in an instant on one or two macro prints or central bank signals. Moves in the dollar and the yield curve can reprice growth stories. Sector news, AI demand, HBM DRAM capacity, supply chain, supplier customer comments and competitors' actions can quickly reshape expectations. Meanwhile, market technicals aren't secondary either. Volatility, options positioning, volume, and key levels can override the narrative in the short term. Therefore, in the week before the report, I'll run a full, updated review. I'll go through the macro, inflation calendar, yields, dollar, signals from the sector and supply chain, competitor and customer statements. I'll assess valuation against revenue/earnings expectations, and I'll examine the technical picture, trend, support resistance, breadth, volume, options flow. If the fundamentals and demand signals are strong, valuation isn't stretched, and the technicals are healthy, I will hold or adjust weights cautiously. If the risk or return deteriorates, for example stretched valuation, weakening outlook, fragile technicals, I will take partial profits or re-weight. If the outlook worsens materially and the technical signals confirm it, I will close the chipmaker exposure entirely. In short, I won't cling dogmatically, but I won't rush either. Prepared for changes over these 3 weeks, I will make a disciplined portfolio decision in the penultimate week. So let's see how the 3 strategies have evolved. Strategy 1. Lump sum. One-time investment, blue line on the chart. The first investor bought an S&P 500 ETF on January 2, 2025, investing the entire $15,000 at once. They've held the position ever since, no additions, no withdrawals. Current performance year-to-date, 8.63%. The blue line reflects this result based on the most recent Friday closing price. Strategy 2. Dollar cost averaging. Gradual investment, green line on the chart. The second investor splits the $15,000 into 12 equal parts, investing $1,250 on the second trading day of each month into the same S&P 500 ETF. This approach helps smooth out volatility and reduces the risk of poor entry timing. Current performance year-to-date, 9.15%. The green line reflects this strategy, slightly outperforming the lump sum method so far. Strategy 3, my fictional portfolio, red line on the chart. This portfolio is based on my own stock picks and investment decisions. It launched on March 19, 2025, with the full $15,000 invested in various individual stocks over multiple transactions. I've explained my choices in earlier videos. Current performance year-to-date, 33.26%. Note, these performance metrics exclude broker fees and taxes. They reflect only market-based price movements. Thank you for joining us on this economic journey with Test Portfolio XSX. If you enjoyed this weekly recap of the key events and our portfolio's performance, give it a like, subscribe, and join us again next week as we review the latest market moves and the progress of our investments. Disclaimer. This video does not constitute financial advice and does not recommend the purchase or sale of any financial instruments. I do not take responsibility for any potential inaccuracies or errors that may occur.